Welcome back. I know the market's taken a beating recently, so what I wanted to do was go over some subscriber requested stocks. I'm going to do multiple of these this weekend, so if you have any that you don't see here or that I haven't done before, go ahead and comment and let me know what stocks you want to see, and I'll try to get to them. I will guarantee this though, if two separate people comment the same stock, I'll make sure it winds up on the next group video. And I'm going to try to do another one this weekend, maybe even 3 if we're lucky, if I have time. Alright, so like I said, these are all subscriber requested stocks. I'll just run through them real quick. We got Dell, the laptop computer company. We have UFP Industries. They are a wood and wood alternative products company. They operate in the retail, industrial, and construction segments. Then Mohawk Industries, another construction company. This one also does flooring products, for remodeling and new construction. All right. And then another kind of housing company or company that will go with housing and real estate, that is Encore Wire. And this one is a wire company, like the ticker will tell you. Okay. CSX is next. That is a railroad company. And then finally eBay. I think everybody knows what eBay is. Okay. And then up in the top right of the screen, I got the current share prices as of market close today and the market caps as well. Okay, so what we're going to do, if you haven't seen one of these videos before, is I'm just going to run through the balance sheet, the income statement. I'm going to give it a red, green, or a yellow, and then I'm going to come up with just a very back of the hand calculation for fair value. I have not looked at these stocks at all. I downloaded their data, I put them in my software, and then I'm just going to go through them real fast and try to do like 3 minutes per stock, maybe even less, but usually it runs longer. So we'll see. Let's get started. So first up is Dell, and right now I have every quarterly report. For Dell, it's going to go back to 2016 because that's all the data I had. For the other companies, I think it's going to go back a little further, like the last 10 years or so. All right, so anyway, what we're going to look at first, and this is something I always look at no matter what the stock is, the total equity. So your assets minus your liabilities. Yahoo Finance is going to call this total equity gross minority interest, and so that's why I kept it written as that, but that's just how they classify it. But it's your net worth, basically. It's your paper net worth, assets minus liabilities. All right, so what we like to see here is growing because, who wouldn't want to invest in a company that's net worth is growing, right? And yeah, this is, what's going on? This isn't great. So let's dig into this a little bit further. Like I said, obviously it's not growing. If a company's equities dropped off, it's usually because either they went into debt or they got rid of some assets. Okay, so assets went down. That's one thing. Let's see if debt went down too. If debt didn't go down, but assets went down, that's bad. Okay, so they both went down. Real quick, if it had just been assets, I'd be worried about like a write-off, and write-offs suck, But anyway, I don't know what happened. They probably sold some segment or something like that if I had to guess, and whoever knows this company better than me probably knows exactly what's going on. All right, for a product company like Dell, one thing I'm also going to look at is inventory, okay? Because inventory for a product company, you want to make sure it's not going up. Because if inventory is going up, especially finished product inventory, so let me look at finished goods. It's going up a little bit. That will tell you that, they're building up finished products on the store floor, especially like technology product companies, because that can go out of date really fast. So you do not want to get caught with a bunch of inventory on the floor that you can't get rid of. I'm not a big fan of this inventory going up. I think that combined with the negative equity and just general trend of the equity is going to give this one a red for the balance sheet. Okay, so let's go to the income statement real fast. All right, total revenue. Yeah, this is dropping off too, but if they did sell a segment, I would assume that their revenue would drop too, right? Because, that would make sense. Let's go to income. Let me just see their pre-tax income. Yeah, this is, man, something's going on. So they sold something. Did they sell it at a loss? And it was climbing before that, so I don't want to ding them too hard for this. They were making some progress. If we look at earnings per share, actually, I'm going to do like this. For pre-tax income, I can break this down and see if it was operating income that went down. Operating income went down, but they didn't lose money there. They must have lost money on some kind of sale of or other income. So let me see. Other income, expense. Okay, yes. Okay, so here's my other income, and then let me break it down a little bit further. Not that. Not gain a sale on securities, special income charge. Special income charge. So we got $1.5 billion on special income charge. That's kind of weird. And then you had a $4 billion to the positive. It just doesn't make sense to me. It's kind of confusing. Let me look at earnings real quick. This was kind of a bad one to start off. This one's all over the place, but that's why I like to look at things graphically, right? Because you could just look at snapshots on the like on their 10Q or something and think everything's all right, but then you look at something like this and you're like, what's going on? Yeah, earnings aren't great either. You're hovering around zero. Okay, so they're getting yellow here. They're not consistently losing money, and if I look at their income, or if I look at their revenue, they are kind of growing, so I'm going to keep them yellow. Now let me look at pre-tax income, and I'm going to use this to kind of get an estimate on fair value for the stock. So if I do that, let's just say they're going to be around this $1 billion per quarter mark. So if it's going to be $1 billion per quarter, so that's $4 billion for the year of pre-tax income. Then I know I usually multiply rule of thumb by 10 and then ratio that to the market cap. But because the growth is so low and because they got this negative equity and all that, I'm going to multiply by 8. I just think that's more accurate, and so I get a market cap target of $32 billion. So if I ratio that to the share price, that's going to give me an estimated value. So I divide by the market cap, because my expected market cap is 32 billion, so I'm going to divide by the market cap to get that, and then multiply it by the share price, and I get a estimated value of $42 a share for the stock. Don't like that one at all. All right, let's move on to UFPI. All right, this is the type of equity growth we like to see, all right? If you hold this company, this is what you love to look at. This is what all the good companies look like. Because like I said before, if a company is growing equity, it means they're growing the net worth of the business, okay? Their assets are going up faster than their debts. All right, so that's great. Next, I want to look at their number of shares, see if they're buying back shares, or if it's the same. Let's see. Where is it? Ordinary shares number. All right, right here. So actually a little bit of dilution, not much. This dollar sign shouldn't be here real quick. Let me remove that. Yeah, I mean, I say dilution, but I mean, you're only going from like 60 to 62. So that's 62 divided by 60. That's like 3%. That's nothing to really worry about. I'm not too concerned about that. But anyway, just interesting. Let me look at one more thing. I want to look at their debt, or I want to look at their working capital. That's their current assets minus their current liabilities. Wow. This is awesome too. So working capital, like I said, current assets, which current assets means assets that you're expecting to turn into cash in 1 year or less. And then current liabilities are debts that you're expecting to have to pay in a year or less. So it's really good to see that, because if you see it high like this and growing like this, it means that, you know, the company's in a very good financial position. Okay, so let's go to the income statement. Total revenue. Okay, that's growing. This is also great. You see, you know what I mean, revenue's growing, and it's growing at an increasing rate. So that's good to see. Now remember, this company is tied to the housing market, I assume. I would expect it to be going up since housing prices are going up like crazy. All right, what do I want to look at? Let's see their pre-tax income. Yeah, that's going up really fast. Wow. So is this just an uptick on a cycle, or is it going to be staying that way? Okay. I don't know. I mean, it's growing pretty good. I tell you what, I'm going to take this number right here, $200 million a quarter, multiply by 4 to get a yearly estimate for the income, and I'll multiply that by 10, which would be 8,000 million, so 8 billion. 8 billion divided by 4.9 times, what's the share price? 78, so 127. Wow. All right, triple green on this one. I really like this stock so far. I worry a little bit that it might be, you know, in a bubble because of the housing market, but I think that one's definitely worth a deeper dive. All right, so let's keep on going. Next is Mohawk. So Mohawk is another one that I'm expecting to be kind of on the same pattern, because it's also tied to real estate, or it should be, right? I think they were the flooring company, huh? All right, so equity's growing. That's good. I mean, let's see. Not growing as much recently. Let me see. Maybe that's because they're buying back shares. So let me go look at number of shares, see if they're buying back shares. Oh, yes. All right. This is awesome. Look how much they're buying back shares. If they're buying back shares like this, that's a great sign, right? Because companies buy back shares whenever they think, well, let me rephrase that. Companies with rational managers buy back shares whenever they can get a better return on their money buying back shares than they can by reinvesting in the business, okay? And like I just said about the other company, business was booming, right? So let me show you this too. If you look at their total equity, so let me go back to total equity. It looked like it was shrinking because it went from like, what was this, 8.7 to 8.3. So it went from 8.7 billion to 8.3 billion. And real quick, look at that. The total equity is almost equal to the market cap. So it's got a PB close to 1. That's awesome. All right, so equity went from 8.7 to 8.3. And if I go to number of shares, what we're going to look at is what the equity per share did, okay? Because back up here, whenever it was 8.7, you had 70 million shares outstanding. So 870 divided by 70 million, you had a price to book. I mean, not a price to book. You had a equity per share of $124 per share. But now, even though you're 8.3 billion, you have, what is this, 60, 64? Yeah. Now you have an equity per share of $130 a share. So even though your total equity is going down for the company, your equity per share is going to be going up because of how much they're buying back shares. Okay, so this is also a green on the balance sheet. Very well run company by the balance sheet. Like I said, I love judging companies by the balance sheet. I think you can really just get a feel for management by looking at that alone. All right, let me go to the income statement. Total revenues increasing. That's good. And look at this. It's not just increasing because of the COVID spike. I mean, it was increasing before that. This is the last 10 years, every quarter. All right, that's great. Now let's look at their pre-tax income. But I'm not going to look at pre-tax income as much as I'm going to look at their earnings per share. Well, let me look at this too. So, well, COVID, yeah, I mean, obviously, a lot of people had bad COVID quarters. Let's look at earnings per share. And the reason I want to look at earnings per share for this company, hold up. I was about to say the reason I want to look at earnings per share for this company is because they're buying back shares, so it should be a lot higher, but what's going on here? Okay, let me dig into this a little bit. Pre-tax income was good. Okay, so did we have a huge tax provision? Not really. What's going on? Net income high. What's going on? Earnings per share. Doesn't really make sense. Give me 1 second. I'm going to try to find an error in this. All right, crisis averted. I found the error. It was just a data error on the front end. All right, that's why the software is tricky and we haven't released it yet, huh? All right, so let's see. Yeah, earnings per share, let's say around $3 a share per quarter. So $3 a share per quarter times 4 is 12. And, they're growing pretty good. They're in a good industry. So I'm going to multiply this by... Remember, this is after tax. I'm going to be a little bit more aggressive than just 10 because that would be a pre-tax income. So let's say I multiply by 13. Yeah. All right, so that's 156 is my target share price. And the income statement I'm giving green too, just because the revenue's growing, earnings are growing. Right? That's good. Let's move on. Next one is going to be the wire company, Encore. Now, this is what I'm talking about on equity growth, all right? This is called capitalizing on a good time in the market. Because you can see even their equity growth was kind of steady for a while before, the COVID housing boom, and now they're really taking advantage of it, all right? And I want to reiterate this, okay? Because it's easy for companies to generate high income whenever they're in an uptick in the cycle, all right? It's hard for companies. It's not hard, but a lot of companies are stubborn about increasing their net worth during that time, right? Because they just want to keep on. Some companies, what they'll do is they'll be in a boom in the cycle and they'll just put it all into CapEx, trying to expand. And then by the time they do that, everybody else has thought the same thing. So everybody's got too much supply, and then it inverts and the market crashes, and now you didn't really use your uptake in the cycle to make any money, and your net worth is the same. Okay, you see that with big commodity companies all the time, especially in the chemical and just manufacturing industry. So anyway, really nice to see this. That's awesome. They could get a green for that alone. I'm going to look real quick at inventory just because I want to see, okay, it is rising, so that could be a little bit concerning that inventory is building up because maybe that the market's starting to slow down a little bit. Let's see if it's from raw materials or finished goods. Raw materials are going down. Now, they are approaching kind of historical levels, but still, I always say you want to be a little suspicious if you see raw materials going down and finished products going up. So let's see, finished goods. Yeah. All right, so if I see finished goods going up and raw materials going down, in my head, what I imagine is you have some company where they're starting to slow down production, and because they've built up so much finished goods inventory because they can't sell it, and they've even started calling off raw material orders. So that makes me a little bit nervous, all right? Anyway, let's just look at the number of shares, see if they're buying back shares. They are buying back shares, which is good. They're still going to get a yellow. Well, the balance sheet health is good, but the inventory is part of the balance sheet, and I worry that that might be a sign of a near-term market correction or something of the sort. So it makes me a little bit nervous. All right, let's go to the income statement. Total revenue really growing, they had this big spike up, and it looks like they're staying there. I'm a little worried that they might be coming back down to earth because of the inventory stuff that we saw. Let's see what else. Let's just look at their pre-tax income. I'm going to be fast here. All right, so $200 million per quarter in pre-tax income recently. Let's say, man, look at the spike though. I mean, this came out of nowhere. Is this going to last? I have no idea. What's the market cap right now? 2.5 billion. So the market cap's like priced in for them to be making what, like 50 to 60 million dollars a quarter? That's kind of crazy. Let's do this. Let's fit a trend line. Let's let Excel help us here. Trend line linear. Yeah, because this is a very linear graph, right? It's saying what, 190? Oh, this is tough. This is why screening process is super tough. I'd say this stock really intrigues me because I want to know the story a little bit. I want to know what's going on. Because if they're going to stay up here, let me just show you real quick. If they're going to stay up here in the 200 million per quarter, I mean, to me, that means that their market cap should be 8 billion. And so right now it's 2.5 billion. So I'm looking at something that's going to get, 3x. Like I'm expecting the share price to be what? $400 if they're going to stay at this $200 million a quarter range. So that would be a huge gain in the share price. If they're back here, let's just say 75. Okay, I'm going to go easy. So 75 times 4, 300 times 10, divided by times 129, 155. Okay. This one is going to have a big asterisk next to it. What do I want to put for the income statement? I'm going to put yellow there too. Well, yeah, I'll just leave it yellow. All right, like I said, this one's got a big asterisk. I want to know the full story here. We got 3 good ones in a row that I want to do a deeper dive into, at least on my own time. So great suggestions. Whoever's suggesting these, appreciate it. Sorry if I'm confusing you more than I need to. All right, let's move on to the railroad company, CSX. So here's our equity growth, and it's pretty modest. It's not great, but at least it's growing, right? I mean, it's better than seeing somebody shrink in equity. Let's see, total assets. They have about $40 billion of assets, and their debt, this is what I want to look at, their debt to equity ratio. So they have about $27 billion of debt, and then $27 billion of liabilities, and then their equity is, what was it? It was, 13-ish. So 27 divided by 13. Debt to equity ratio of 2. Look, I've said before, textbook definition is, under 2, maybe under 2.5 is okay. I prefer like around 1 or less than 1. Okay, I love companies with low debt. That's way more attractive to me. So all that being said, this is getting a yellow. Look, it's not shrinking, but there's nothing super impressive about the balance sheet. All right, let's go to the income statement. Total revenue is pretty flat too. Man, anybody with flat revenue, it's going to be hard for me to give them a green. It's going to be hard to get a yellow too if your revenue is flat. As long as you're not. Okay, yeah, this is good. Okay, so pre-tax income. I was going to say as long as you're not losing money, or as long as your pre-tax income's not flat either. So it's pretty good that your revenue is flat, but your pre-tax income's growing. That's, good, means that you're running more efficiently, that your costs are going down. So that's a good sign. Don't like this recent trend of just last 3 quarters have been down. Anyway, look, the growth is pretty modest on this company. I'm going to put a lower multiple on the pre-tax income, like maybe multiply by 8 like I did on the other one up there. I forget which one I did that for. I think it was Dell. So anyway, let's say that they're going to be, what is this most recent one? 1.1 billion a quarter times 4. This 4.4 is what I'm kind of estimating their pre-tax income to be. I'm going to multiply that by 8, remember, and I think it should be like $35 billion for the market cap. Ratio that down to what their market cap is right now, and I get, share price of $16. Yeah, I mean, maybe I'm missing something. I just think this is kind of it looks pretty stagnant, slow moving, and it looks like it's trading at a pretty high multiple of earnings. So even if you took this peak earnings here, like let's say $1.5 billion a quarter, so $1.5 billion times 4 is $6 billion. You'd have to multiply that by 12. Yeah, and you still wouldn't be at the market cap. Wow. Yeah, that's crazy. Okay, so I don't know. I think they're just a little overvalued. Usually you don't see a high multiple on the earnings unless your growth's really high, and the growth just is not there. So I'm not going to be looking into that one any further. All right, let's go to the last one, eBay. eBay's equity, not good, huh? Dang. Let's see. They have $10 billion. I don't know. This is all over the place. This is so hard to judge. Let's see. Let me just look. Let me do a debt to equity ratio like I did for the other ones. So our current equity is $10 billion. Total liabilities is, what is this, like 16, 17? So 17 divided by 10, debt to equity ratio of 1.7, okay? So less than 2, textbook definition of good, right? I'm just curious what's going on here. So eBay, it's hard to judge their balance sheet, right? I'm going to really be judging their income statement. So I just want to see if they're buying back shares real quick. Ah, they are. Whoa, they're buying back a lot of shares. Holy cow. Look at this. This is awesome. 600,000 shares outstanding now, and it was 1.2 billion, or I said 1,000. 600 million shares outstanding now, and it was 1.2 billion. So they've bought half the market cap. All right, I was going to give this balance sheet a red, but that has promoted it to a yellow. All right, let's go to the income statement. All right, revenue is pretty flat, but I mean, at least it's growing a little bit. But yeah, there's nothing impressive there. Let's see what their income's been doing. Pre-tax income. Shrinking. Okay, that gets a red. Oof. All right, so what do I want to put here? Let's say they're making $500 million a quarter. So I'm going to be a little bit more than that. I'm going to say 600 million. So let's say they're making 600 million a quarter. That's 2.4 billion. 2.4 billion times 10 is $24 billion for the market cap. So I think the share price, roughly, first estimate, $38 a share. All right. We started off bad, then we had 3 solid ones in the middle, and ended bad. Anyway, look, I really appreciate the suggestions. I hope I did something for you. You know, if you have any other stocks you want to see, like I said, leave them in the comments. I'm going to try to do this through the weekend because I feel like I owe y'all that at least for watching all the videos. So really, any other companies that you want, leave them. I'll try to work them in.